Let's get oriented. I'm Lázaro Ulloa, owner and founder of Ulloa Financial, and this is your Market Compass week ahead for Monday, April 13th, 2026. Last week was a turning point for the market, but not without volatility. We began the week with cautious optimism as markets built on the prior rebound. The S&P 500, the Dow, and the Nasdaq extended gains early in the week, supported by strong economic data and continued resilience in the labor market. But the real story was geopolitics and energy. Oil prices had surged above $110 a barrel amid Middle East tensions, and they reversed sharply midweek following temporary ceasefire announcements. That shift triggered a powerful rally with the Dow jumping more than 1,000 points in a single session, and the S&P 500 and Nasdaq both posting strong gains. At the same time, inflation remains a key concern. While headline inflation continues to be influenced by energy prices, core inflation appears more stable, reinforcing the idea that the Federal Reserve is still navigating a delicate balance. Then came the Fed minutes, and the tone was very clear. While many policymakers remain in a wait and see posture, there is a growing awareness that persistent inflation, particularly from energy, could delay rate cuts or even shift the conversation back towards tightening if conditions worsen. At the same time, bond yields pulled back last week, with the 10-year Treasury acting as a key thermometer for market sentiment. That pullback helps support equities, especially growth stocks, but it will be important to watch whether yields remain constrained or begin rising again. So here's the takeaway from last week. The market rallied, but it rallied on relief and not resolution. Now let's look at this week. And this week is crucial. The market is entering the early stages of earnings season, and this is where narratives meet reality. Major banks like JP Morgan and Goldman Sachs are set to report, along with key companies across technology and industrial sectors. These earnings will help answer one central question. Are companies absorbing higher costs, or are margins starting to compress? At the same time, technology continues to play a central role in supporting the broader market. Despite geopolitical tensions and inflation concerns, strength in AI and large cap tech has helped stabilize the S&P 500. So what am I watching this week? Four things. First, earnings and quality. Not just whether companies beat expectations, but how they guide forward. Second, oil stability. If crude remains below recent highs, it helps ease inflation pressure. If it spikes again, the entire narrative shifts quickly. Third, interest rates, specifically the 10-year Treasury yield. If yields remain stable or move lower, that supports equities. If they rise, it could put pressure back on valuations. And finally, geopolitical headlines. The market reacted strongly to the ceasefire, but it's important to remember this is a provisional 2-week window. In many ways, the clock is now ticking on diplomacy, and any shift in that narrative could quickly reverse market sentiment. Here's the bottom line. The market has shifted from fear to cautious optimism, but optimism needs confirmation. This week is not just about momentum, it's about validation. Now, 2 quick tips depending on your risk tolerance. If you have a high risk tolerance, this is the time to be selective, not aggressive. Opportunities are forming, particularly in areas like technology and AI that have shown resilience, but chasing strength without discipline can expose you to sharp reversals. If you have low risk tolerance, this is a time to stay anchored. The recent rebound does not eliminate risk. Focus on diversification, maintain appropriate cash reserves, and make sure your portfolio is aligned with your long-term goals and not short-term market swings. Stay oriented and elevate your legacy.